Leaving your savings in a standard high street bank account feels responsible. The balance never goes down. But that stability is an illusion. Over the last decade, UK inflation has steadily eroded the value of the pound. Even at a target rate of 2%, the cost of everyday goods compounds, silently stripping away your purchasing power month after month. This chart shows exactly what that erosion looks like over 10 years. If you hold £10,000 in cash, inflation drags its real purchasing power down. If you invest that same $10,000 into an index fund growing at a conservative 5% annually, the line moves in the opposite direction. Broad index funds, baskets of stocks that track the entire market, are the most mathematically reliable mechanism for beginners to stop this decay and reverse the trajectory of their wealth. The greatest danger to a beginner's portfolio in 2026 is not a sudden stock market crash. It is the guaranteed, silent loss of wealth that comes from doing absolutely nothing. Once you decide to invest, you hit an immediate roadblock. Open a modern UK platform like Trading 212 or Vanguard, and you are met with thousands of overlapping funds, tickers, and charts. This volume of choice usually traps beginners into one of three profiles: the overwhelmed novice who freezes entirely, the cost-conscious optimizer who builds complex spreadsheets, and the social media scroller chasing whatever ticker symbol is trending online. Every single one of them is navigating the exact same trade-off: absolute simplicity on one side and granular, hands-on control on the other. The paralysis happens because new investors assume they must hunt for the single perfect fund with the highest past returns. They hold on to their cash, terrified of making a mathematically suboptimal choice. But successful investing does not require predicting the top-performing asset. It requires finding a fund with low fees that you can hold consistently for decades without interfering. Building a long-term portfolio is an exercise in managing human behavioral friction. The actual stock selection is secondary. To find the right fit for your behavior, we need to evaluate the 4 distinct paths available to a UK investor. This matrix evaluates these paths by their inputs, trade-offs, and risks. The first approach is the one-and-done global tracker, like the FTSE Global All Cap. The FTSE Global All Cap is a market index that captures thousands of companies of all sizes from around the world. By purchasing a single fund, you buy a tiny slice of the entire global stock market. The fund automatically rebalances itself as companies grow or shrink. The primary trade-off here is cost and rigidity. You pay a slightly higher combined fund fee for the convenience of automation, and you cannot exclude specific geographic regions if they underperform. The second path is the S&P 500, a strategy heavily promoted by global financial influencers. The S&P 500 is a stock market index tracking the stock performance of 500 of the largest companies listed on stock exchanges in the United States. This route has delivered high historical returns, driven almost entirely by a handful of mega-cap American technology stocks. But buying a US fund introduces a massive variable for UK residents: currency risk, or FX risk. FX risk occurs when the value of your investments fluctuates based on the exchange rate between the British pound and the US dollar. If the US stock market rises by 10%, but the pound strengthens against the dollar by 10% at the same time, your actual returns in the UK will flatline. You are also accepting extreme geographic concentration risk. Your financial future is tied exclusively to the regulatory and economic health of a single country. Blindly copying US-centric financial advice without adjusting for the exchange rate exposes a UK beginner to risks they are not compensated for. Many new investors intuitively understand this danger and decide to buy locally, keeping their money exactly where they live. Returning to our comparison matrix, we see the third path, the UK equity tracker, which follows domestic indexes like the FTSE 100 or 250. Keeping your money in UK indexes completely eliminates currency exchange risk. Historically, these funds also offer higher dividend yields, providing regular cash payouts. The cost of this safety is the opportunity cost of growth. The UK market is heavily concentrated in legacy sectors like banking, mining, and oil. By excluding international markets, you largely miss out on the expansion of the global technology sector. The fourth path is the DIY regional mix, built for the optimizer. Instead of paying one fund manager to balance the globe, you buy separate funds for the US, Europe, emerging markets, and the UK. The goal is to drive your ongoing platform fees down to the absolute mathematical floor, but this requires strict inputs. You must calculate your target percentages, log in annually, and perform spreadsheet math to buy and sell assets until your portfolio is rebalanced to your original target weights. This method creates a severe behavioral trap. When you manually control the levers, there is a constant temptation to tinker, adjust weightings based on the news, and attempt to time the market. Achieving a 0.1% reduction in platform fees is meaningless if the strategy demands more emotional discipline than you actually possess. Evaluating these funds by their objective traits will only get you halfway to a decision. You have to evaluate your own psychology. This flowchart maps that psychological logic. The first node asks, are you willing to log in once a year to perform manual spreadsheet math? If no, we follow the path to a secondary question. Do you fully accept currency risk? If you don't want to manage spreadsheets or worry about exchange rates, the overwhelmed novice maps directly to the global tracker. Think of the slightly higher fee as an insurance premium against fatal behavioral mistakes. Conversely, the cost-conscious optimizer maps to the DIY regional mix. But this path only works if you can maintain robotic discipline during market downturns. The right fund is rarely the one with the most optimal math on paper. It is the fund you can hold for 3 decades without feeling the urge to check its price every day. Once you select your fund, the execution step matters just as much. The right index fund is useless if you put it in the wrong account. In the UK, you must house these investments inside a stocks and shares ISA. An ISA, or Individual Savings Account, is a government-approved tax shelter. This bar chart shows the exact value of that protection. Over 20 years, a standard investing account will have its compound growth heavily eroded by capital gains tax. Inside the ISA wrapper, 100% of your capital growth and dividend yields remain intact. Execution takes 3 distinct steps. First, choose a low-cost UK platform and open the Stocks and Shares ISA wrapper. Second, set up an automated monthly direct debit to systematically buy your chosen index fund. This completely removes your own willpower from the equation. Third, and most importantly, delete the brokerage app from your fund's home screen. The harder it is to log in, the less likely you are to panic sell during inevitable market dips. Successful index investing in 2026 is not an intellectual puzzle to be solved. It is simply a boring, reliable system designed to outlast human anxiety.